What if I told you that making money in the stock market has nothing to do with being a genius and everything to do with being patient? Today, we're breaking down one of the most important finance books ever written, The Intelligent Investor by Benjamin Graham. Warren Buffett calls it the best book on investing ever written. In the next hour, I will explain every big idea in simple words. No complex math, no Wall Street jargon. Just clear, practical steps to help you invest safely, sleep well at night, and build wealth slowly but surely. If you want to stop guessing and start investing with a real plan, stay with me till the end. Chapter 1. Investment versus Speculation. Let's start with the most important idea in the book, the difference between investing and speculating. Graham says an investment is a careful choice. You study the facts, you protect your money, you expect a fair return over time. Speculation is different. It's buying something just because you hope the price will go up quickly. You don't know why it's cheap or expensive. You're guessing. And guessing is gambling. Think of it like this. Buying a house to rent out for years is investing. Buying a house just to flip it in 3 months because everyone says prices are rising, that's speculation. Graham's rule is simple. If you cannot explain in one sentence why you are buying something, you are speculating. And speculation is how most people lose money. Markets go up and down. If you buy without a reason, fear will make you sell at the worst time. If you buy with a reason, you can stay calm. So before you buy anything, ask yourself, am I investing or am I just hoping? Chapter 2. Two types of investors. Graham divides all investors into two groups. You only need to pick one. Type 1, the defensive investor. You want safety. You don't want to spend hours studying companies. You prefer steady results. That's okay. Graham says most people should choose this path. The defensive investor uses simple rules. Buy low-cost index funds, keep a mix of stocks and bonds, and rebalance once a year. You don't try to beat the market. You just let the market work for you. Type 2, the enterprising investor. You are willing to spend time. You research companies. You look for bargains. You accept more work for a chance at higher returns. But here's the warning. Being enterprising does not mean taking more risk. It means doing more work to find better prices. If you don't have the time or interest, do not pretend to be enterprising. Graham's message is clear. Know your type, stick to it. Never switch because of market noise. Imagine driving. The defensive investor uses cruise control on a safe highway. The enterprising investor drives manually on winding roads. Both reach the destination, but you must pick your road before you start. Chapter 3. Meet Mr. Market. Now, let's talk about the most famous idea in the book, Mr. Market. Graham asks you to imagine the stock market as a person. His name is Mr. Market. Every day, he knocks on your door and offers to buy your shares or sell you new ones. Some days, he is very happy. He offers high prices. Other days, he is scared or depressed. He offers very low prices. But here's the secret. Mr. Market is not your boss. He is your servant. You don't have to accept his price every day. If he offers a fair price, you can trade. If he offers a crazy high price, you can wait. If he offers a crazy low price, you can buy. You control when to listen to him. Think of a small coffee shop you own. One day, a stranger says it's worth $1 million. Next day, he says it's worth $400,000. Do you sell just because he says so? No. You know what the shop is really worth. You wait for a good offer. The market is the same. Use Mr. Market's moods when they help you. Ignore him when they don't. Chapter 4. Margin of Safety. This is the heart of the book. Graham calls it the margin of safety. It means always buy something for less than it is worth. Leave room for error. If a business is truly worth $100, try to buy it at $70. That $30 gap is your safety net. Why? Because you will make mistakes. Markets will drop. Companies will face bad news. The margin of safety protects you from bad luck, bad timing, or wrong guesses. It's like building a bridge. Engineers don't build it to hold exactly the weight of the cars. They build it to hold twice as much. That extra strength is the margin of safety. In investing, never pay full price. Always leave a gap. When you buy with a margin of safety, you don't need to be perfect. You just need to be careful. And remember, the margin of safety is not just a number. It's a mindset. It keeps you humble. It stops you from chasing hot stocks. It helps you sleep well when markets fall. Chapter 5. Building a Smart Portfolio. How do you put this into practice? Graham gives simple portfolio rules. Rule 1, never put all your money in one place. Spread it out. Rule 2, divide between stocks and bonds. For defensive investors, 50% stocks and 50% bonds is a good start. You can go 75-25 or 25-75, but never 100-0. Rule 3, rebalance once a year. This means you check your split. If stocks went up and now they are 70% of your portfolio, you sell some and buy bonds to return to 50-50. Why does this work? Because rebalancing forces you to do the hard thing. Sell what went up, buy what went down. It removes emotion. It keeps you disciplined. Today, you don't need to pick individual stocks. Low-cost index funds make this easy. Graham didn't have them, but he would love them. They follow the market, charge low fees, and work perfectly for defensive investors. Your portfolio is not a race car. It's a slow, steady ship. You don't need to steer it every day. Just check the compass once a year. Chapter 6. Reading numbers simply. You do not need to be an accountant to invest well. Graham says just check 4 simple things. Earnings. Is the company making money? Are profits steady or growing? Avoid companies that lose money year after year. Debt. How much does it owe? Low debt means less risk. High debt can sink a company in bad times. Dividends. Has it paid owners for many years? A long dividend history shows stability. Price. Are you paying too much? A simple check is the P/E ratio. If a company earns $5 per share and the stock costs $75, the P/E is 15. Generally, a P/E under 15 is reasonable. Over 25 needs caution. Do not fall in love with stories about the future. Look at what the company has already done. The past does not guarantee the future, but it shows behavior. And remember, cheap does not always mean good, but expensive is never safe. Chapter 7. Emotions, Discipline, and Time. The biggest enemy in investing is not the market. It is your own mind. Fear makes you sell when prices drop. Greed makes you buy when prices rise. Both destroy wealth. Graham's solution? Make your rules before emotions arrive. Write them down. Follow them like a contract. Time is your best friend. In 1 year, the market is unpredictable. In 10 years, it smooths out. Companies that earn money will reflect that in their price. Noise disappears. Value shows. Remember this famous line. In the short run, the market is a voting machine. In the long run, it is a weighing machine. Short term, people vote with fear and hype. Long term, reality weighs the actual value. So do not watch prices daily. Check them monthly. Think in years, not days. Patience is not waiting. Patience is staying calm while waiting. Chapter 8. Real-life action steps. Let's turn this into action. Here is your simple checklist. Decide, are you defensive or enterprising? Pick one. Never speculate. Only invest with a written reason. Use Mr. Market's prices when they help you. Ignore him when they don't. Always buy with a margin of safety. leave room for error. Keep 25% to 75% in stocks and bonds. Rebalance once a year. Check earnings, debt, dividends, and price. Avoid complex stories. Write your rules, follow them, wait at least 10 years. Modern tools make this easier. Index funds, dollar cost averaging, automatic rebalancing. Use them. And one last warning. Avoid hot tips, quick riches, and this time is different stories. They always sound exciting. They always end the same way. Summary and call to action. Let's quickly review the 3 pillars of the intelligent investor. Know your investor type. Stick to it. Treat Mr. Market as a servant, not a master. Always buy with a margin of safety. You don't need to be a genius. You just need to be patient, disciplined, and humble. If you found this summary helpful, please like, subscribe, and comment safety first below. I'll send you a free 1-page checklist in the description. Watch next The Psychology of Money Summarized, or Rich Dad Poor Dad in simple English. Thank you for watching. Invest wisely, stay calm, and I'll see you in the next video.